Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. September has certainly proven to be a volatile month, and the question is, what is the catalyst behind markets that are moving 3 to 5% to the up and down side all the time? And it's not due to what's already out there. Joining me to discuss is George Ball, CEO of SMH Group. George, it's great to have you with us. Welcome to Trade Talks.
Thanks, Jill.
And the election will eventually be a factor, but what do you think may be the next game changer?
The next game changer is not anything that's really in the markets today. And just to go backward, it's not a COVID vaccine. People expect we'll have one by the first quarter of next year. It's not low interest rates forever, because forever is at least a 2 or 3 year period in all likelihood. It's not the trumpet of the day. People disregard those pretty well. And the market right now is looking at the Irish bookies, the Irish punters' odds of 70% Biden, 30% Trump. And that's how the market's priced right now. So the day-to-day fluctuations that are terrifying, it's like a out-of-control roller coaster, I think schizophrenia as opposed to anything that's really lucid or apt to move the markets dramatically in one direction, up or down. So your question is the right one then. What's the catalyst that's going to drive the market 10% higher or 10% lower in something like a straight line? I think it's the backlash of the end of the PPP employment period. So to elucidate on that, you're at a point where most of the PPP borrowers can have their loans forgiven if they fire the people that they kept on the payrolls unnecessarily, because the government was paying them to keep them on the payrolls. The elapsation period is winding down fairly rapidly. Small businesses, defined by the government as 500 people and under, provide 64% of the job growth and 49% of all of the jobs in the United States. I can't prove it, nobody can really prove it at the moment, but there are lots of those leisure industry employees, restaurant employees, people like that who really are needed, but they've been kept on the payroll because of PPP payments. If you're a small business, you still can't reopen. There's not that much need for all the people you have. You can let some of them go, maybe a lot of them, and that could dramatically increase the unemployment rate, and that could scare the hell out of the market.
George, I would agree with you there, because of course we saw that bump, an improvement in the employment data as things were starting to reopen. But this is where I agree with you. With millions of Americans not going back to work at businesses that no longer exist, what's going to happen to them? Will they have to be retrained to enter other areas of the workforce? I mean, that's a massive segment of people we're talking about.
Well, there are two possibilities. The political possibility is that a newly elected president, whether the old one or Vice President Biden, reinstate the PPP program and basically kick the can for small employers another 3 or 6 months down the road, and then look around and see what's happening then. And that's politically expedient. Most politicians are expedient, so that's quite possibly the wisest course. It may not be a courageous one, but it could be a very wise course. The other one is that what's being termed correctly as a K-shaped recovery becomes worse, that bottom leg of the K becomes so unpalatable that we resort to some other measure that's draconian, that's more socialistic than capitalistic, and that could be gutting for the markets, I'm afraid.
So what's an investor to do at this juncture?
Number one, don't try to trade the markets. Schizophrenia is a very difficult disease to deal with if it's just in somebody's head. If you're trying to bet on the course of the market tomorrow, you shouldn't do it, really and truly. that probably means more cash or cash-like portfolio balance than others. Something, Jill, that I've never said before until last week is that
Yeah, I'm surprised to hear you say that.
yeah, is that I think that the cryptocurrencies, Bitcoin and Ethereum and the like, are going to be a smart speculative bet over the short term and a conservative long-term way to uh, avoid the risk of inflation and the debasement of the currency. On the former front, shorter term, I think the Robin Hooders and the people who want to day trade may say that the moves in Microsoft and Apple and Tesla are so violent and now starting to be downwardly pitched that they're looking for something else in which to speculate. And a cryptocurrency is a very logical way to do it. So I think that the conservative and the speculative investor, and I'm sort of both, may turn to the cryptocurrencies, to Bitcoin or one of the Bitcoin proxies as a way to employ part 5%, 10% of their portfolio.
Yeah, that's really interesting to hear you see. And even watching cryptocurrency and the way that has traded, it was looked at as a safe haven asset at one point, right? Which makes sense. I understand that thesis. But then it also had a lot of volatility over the past couple of weeks, just like the stock market did. But I want to go back to stocks for a minute, and we talk about technology. And of course, there's a lot of new traders out there who made a lot of money in those Nasdaq 100 names like Apple, Microsoft, and so forth, that never saw volatility. They haven't seen it in 6 months, right? So they're seeing it now. But when you think about technology in the long run, as a longer term investor, because of course timing is everything in this game, Microsoft, Apple, all those kinds of stocks, those are the ones that I would think would set you up for longer term growth. They're most likely not going away. They kind of are the newer economy.
Jill, I agree totally, except as an investor today. Somebody, it should have been me, that the prices of the FANGs and the companies like them require you to justify the unjustifiable right now. Over the very long term, sure, but we do have to remember the arithmetic of investment. 100% minus 50% plus 50% gets you to 75%, and that's that's not a comfortable position. So I think right now you avoid the centerfold technology names. Maybe look for smaller technology companies where you don't need 30 or 40% per annum earnings growth for 3 or 4 years. And that may be done by one of these smaller cap technology indexes. But even so, I would downplay technology right now on the theory that the timing is the secret of good comedy, and it applies to investments also.
All right, all excellent points, George. Thanks so much for joining us on Trade Talks.
Thanks, Jill. Enjoyed it.
Thank you. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.